I think the investor today certainly is discouraged. We've been in a lengthy cycle of where we've not seen share prices go up. Not many people are in a good mood. It's a pretty tough environment today. But I think the demand is that we all look at this business differently. But what that means is a greater focus on the balance sheet, making sure that we've got room to navigate. We've got less debt relative to our earnings. We're actually paying out less dollars as a percentage of our cash flow generated. We think of that as dividend or distribution coverage. And so the market wants to see more coverage, less leverage, lower growth. We are in an environment where people don't really want to talk about 20% of growth per year. They want to talk about something that is more manageable, which is probably a mid-single digits type growth with a solid distribution. And so I think people are asking for all of us to focus on delivering return to shareholders in a combination of dividend and moderate growth. Our plan, again, starts with increasing the profitability of our existing business. Secondly, we think down cycles and the cycle that we're in is going to create opportunities that we haven't seen in a while.
Hello and welcome to the Stock Podcast. I'm Nate Abercrombie, the host of the only investing podcast that gives everyone the chance to hear public company CEOs and CFOs describe their business and provide the investment case for their company. In this episode, the Stock Podcast is really excited to bring you an interview with Barry Davis, the CEO of EnLink Midstream, ticker symbol ENLC. When this interview was recorded, EnLink had a market cap of $2.5 billion, total debt of $4.7 billion, cash of $102 million, and a minority interest of $1.7 billion, putting the total enterprise value at just about $8.8 billion. Under the GICS classification system, EnLink falls within the energy sector. All right, I'll stop there. Let's get to the interview with EnLink Midstream CEO Barry Davis. Thank you very much for joining me on this show and taking the time to talk to me.
Yeah, it's great to be with you.
I start off all these interviews with my guest's background. So could you just tell the listeners just a little bit about yourself?
Yeah, again, my name is Barry Davis. I'm chairman and CEO of EnLink Midstream. I have been with EnLink and the predecessor companies since the beginning, which is over 25 years ago when I led the founding of the previous company. And so a role that I'm very familiar with in a company that I'm very proud of and what we've been able to do over the last 25 plus years.
Yeah. And so what brought you back to the role of CEO? I know that you had left, I think it was, 2 years ago?
Yeah. So great question and timely. I did leave the company in January of 2018, left the CEO position. I didn't leave the company. I was executive chairman for about 18 months. Felt like it was the exact right timing to do that. Had a great successor in Mike Garberdine, who I'd worked with for over a dozen years. We were at a very stable place from a company standpoint, had lots of good things going on in a very high growth period. Felt like the table was set, and it was a great time for Mike to take over as CEO. As you know, and I'm sure many of the listeners know, that we've seen dramatic change in the industry environment in the last 18 months. And for us, in particular, we've seen change with the Devon ownership change, which quite frankly started not long after I stepped out of the CEO position. Devon decided to sell its interest due to a need on its part to really accentuate just a few core areas, and midstream investment was no longer something that they wanted to have as part of their company. And so they ultimately sold in the middle of 2018 their position to Global Infrastructure Partners, or GIP, as I will refer to them frequently, I'm sure, throughout the call here. And that really began a series of changes that ultimately led to about 90 days ago, my being asked to rejoin the company as CEO and help navigate through something that certainly we've seen before. This is a cyclical industry. And so in the last, since the beginning of EnLink and its predecessors, we've probably seen 4 or 5 dramatic cycles. And this one is no less than the challenge that we've seen before, but something that we have seen before, and we're optimistic that we'll navigate through it. And I think you'll hear me say several times that we have a path to the other side of this cycle. And today our focus is on executing through it. And I'm glad to be leading from the CEO position.
Yeah, I would really like to get your thoughts on just the overall macro environment within energy right now. But before we get to that, could you talk a little bit about just the origin story for EnLink?
Yeah, for sure. So again, we started from scratch. We started with a handful of relationships that we were consulting for in the early days, building projects, building infrastructure for producer customers that was all around just getting product from the wellhead to the burner tip. And so that's how we started. The very earliest days started in 1992. And in 1996, we formed Crosstex Energy. And many of our folks will know us as Crosstex Energy before we became EnLink in 2014. So with our beginnings really on the upstream end of the pipe, we are still very concentrated, highly concentrated. 75% of our business is what you would characterize as gathering and processing. And about 25% of our business is downstream or delivery, market-facing infrastructure. So to step through that a little bit, today we are in 4 core areas. Our G&P focus is, first of all, in the central Oklahoma stack play. We are the leading infrastructure provider, midstream player in that basin, with a significant volume of over 1 BCF, about 1.2 BCF a day of services provided from a gathering and processing standpoint. So the number 1 position in central Oklahoma. Secondly, we are the leading infrastructure midstream company in the Barnett Shale, or North Texas, as we call it. Again, having about a BCF a day of throughput across our system in the North Texas area, but the number 1 position by far in that play. Thirdly, on a G&P basis, we are a significant player in the Permian Basin with gathering and processing in both the Midland Basin and the Delaware Basin. We are continuously are growing that position rapidly today, and it really is a great source of growth for us going forward. Lastly, our 4th core area, we're the 2nd largest midstream company in Louisiana, serving the Gulf Coast of Louisiana on gas, crude oil, natural gas liquids, and fractionation services that we provide in Louisiana. One thing that I would like to highlight when you look at the company today and where we are, we've grown dramatically over the last 6 years. We've grown from just over $200 million a year of earnings to this year will almost be $1.1 billion. So more than a 4-fold growth over the last 5 or 6 years. And so it's been a very heavy growth and a fast-paced several years for us.
Could you talk just a little bit about your corporate structure and how it differs from a lot of other midstream companies out there today?
Yeah, so we really got our start as a classic MLP, Master Limited Partnership. We came public in 2002 as a Master Limited Partnership. Our general partner was originally held as a C-corp that came public. It was actually the first pure general partner IPO that was done in January of 2004. So kind of leading into, if you will, the MLP and the general partner structure. We operated as that until 2018. Subsequent to GIP buying in the Devon interest, we moved forward with a process to do what we call a simplification transaction, which is simply merging the general partner and the master limited partnership. In that transaction, we eliminated our incentive distribution rights. So today, we are a very simple LLC structure with a check-the-box C-corp tax treatment. And so a very straightforward, normal corporation structure today.
Yeah. And what are some of the benefits of the C-corp structure as compared to MLPs?
Yeah. So again, the simplified structure reduces, creates efficiencies, reduces overhead associated with operating the 2 different companies. The elimination of the IDRs, the incentive distribution rights, is certainly something that the market wanted to see happen, in the last several years. That allows us to have a lower cost of capital and really return more value back to the shareholder of the common shareholders. And so a more efficient structure, I would say better returns to our shareholders. And lastly, we are index eligible on a number of indexes that we were not able to participate in as a master limited partnership. And then for those who are historical MLP investors, we always had to deal with the K1, and in our structure today, that is no longer necessary. And so that's really helpful for a retail investor not having to deal with the K1s you get from a tax standpoint.
Yeah, thanks. You mentioned being eligible for an index, and I find this component really interesting within midstream today, just given the amount of passive investing going on. And from your perspective, do you think the midstream space as a whole has been really hurt in terms of, investor interest by being ineligible for for indexing?
Yeah, I certainly think that that has been an issue, but I don't think is as great of an issue as just the general investor sentiment around the energy space. I think that's been a bigger issue than the index eligibility. And so we just haven't been in favor. There's a lot of different ways to explain it, but I would say in the last 5 years and maybe even longer, energy's been out of favor. And so we're all having to try to regain, if you will, the interest of the investor, whether that's retail investors, institutional investors, and especially the generalist investors. We're really trying to market ourselves and try to do the thing that would bring them back to the midstream and energy space in general.
Yeah, and what do you think is the biggest hurdle in getting generalist investors, retail investors back into midstream?
Nate, I'm going to say, first of all, we have to create returns and value creation, and I think that's been challenged in the last several years. I think we've been through a period of such heavy growth and competitiveness for opportunities in our business that we haven't had real return to the extent that really is attracting the investors. So we've got to do a better job with that. We've got to run our companies more efficiently. We've got to make better investments, and we've got to show real return to our shareholders.
Yeah.
The second thing is I think the other industries have done so well over the last 5 to 10 years. Many people have felt like they didn't need energy exposure, and so as a result, and this, we've seen the share of the S&P decline from over 10% to I think somewhere in the range of 4% today for the energy industry. And so there's just been a lost interest, and I think in time we will be able to get that back. But there's certain things that we need to do also in the way that we run our companies.
No, I can really appreciate that. The firm that I used to work for, we were benchmarked. Most of the funds were benchmarked off of the Russell 1000 Growth Index. And yeah, I think when I first started, it was close to 5%. Maybe I think it was close to 7% of the index, energy that is. And when I left, it was less than 1%, which is just absolutely ludicrous. So could you talk a little bit about, you mentioned energy being out of favor, and in your most recent presentation, I see that, you have listed there a current headwind being just the evolving E&P landscape. Could you talk just a little bit more about what you're seeing right now?
I think part of the investor demand has been for our industry to provide free cash flow. That is after we pay our dividend, after we pay our CapEx or invest in our CapEx, to have free cash flow that is actually building value in the company. And I think that demand, that drumbeat, has been getting louder and louder over the last 2 or 3 years. I think it was first on the upstream side where investors were demanding that producers invest within their own cash flow as opposed to needing to access the capital markets. And so as we saw that occurring, we started to see producers rethink the way that they were budgeting for their drilling and their CapEx plans. And so naturally, that led to less activity. With less capital, less activity results in less volumes of natural gas and crude oil that needs to be moved across the infrastructure that we own. So that really has ultimately resulted in where we are today, which is in a lower growth environment than we were in the past. Now that we know that, we can adjust. We are making adjustments. We have recently, with me coming back into the CEO position, we've established very clearly what our execution priorities are. And our first and foremost focus is to increase the profitability on the existing assets that we have today. We think that there is latent capacity, there is latent profitability across all of our assets. And so we're asking our folks every day to do, with a sense of urgency, everything we can to drive more profitability across our assets. And so I think that's the appropriate and first execution priority that we have.
Yeah. I'd love to get your perspective on just the regulatory situation today and how you're thinking about it going forward with, elections on the horizon. And at a high level, are you concerned?
Well, certainly we have to pay attention to what's happening in the political environment. And there's a lot of rhetoric right now around the oil and gas industry, in particular, what might happen with certain administrations were they to occur around fracking and even a potential ban on fracking. We hear that. We think the reality of that is far, far away from where we are today. But we all have to think about that, and we have to think about the implications. And what I would say is our expectation is more along the lines of more scrutiny around the regulatory process, the permitting process. And so we could see things slow down as a result of the permitting process being more arduous or more difficult. And so we're having to plan for that. I think producers are making plans for that. I think they're building an inventory of drillable locations that they would be able to do even if things were to slow down in a new administration. But look, here's what happens. If you slow it down, then that means you probably end up with a shift of activity into areas that are not on federal land. That could serve us, EnLink, very well. We have a high concentration on privately owned lands. And in particular, our two basins, Oklahoma and North Texas, would benefit from that as we think activity could come back to those areas. Ultimately, I think the thing that the world needs to be concerned about is if you saw any kind of slowdown that would change the supply-demand balance, we could see commodity prices respond. And I think many are predicting that we would see much higher commodity prices. And that's not good for the economy. And I don't think at the end of the day, there are many people that will want to see that happen.
Yeah. So we talked a little bit about investor sentiment, and you've been out at a conference recently, and I'm kind of curious whether or not these are the same types of questions that I just asked that you're hearing out there, or you did hear out there in Dallas, or is there something else that's top of mind from the investors that you're meeting with right now?
Yeah, I think the investor today certainly is discouraged. We've been in a lengthy cycle of where we've not seen share prices go up. People create more value as a result of investing in the space, and so not many people are in a good mood. It's a pretty tough environment today. But I think the demand is that we all look at this business differently, and many people refer to it as Midstream 2.0 or Midstream 3.0, if you will, depending on where you think we've been, if we've been in 2.0 or 1.0 in recent days. But what that means is a greater focus on the balance sheet, making sure that we've got room to navigate. We've got less debt relative to our earnings. We've got more coverage. We're actually paying out less dollars as a percentage of our cash flow generated. We think of that as dividend or distribution coverage. And so the market wants to see more coverage, less leverage, lower growth. We are in an environment where people don't really want to talk about 20% of growth per year. They want to talk about something that is more manageable, which is probably a mid-single digits type growth with a solid distribution. And so I think people are asking for all of us to focus on delivering return to shareholders in a combination of dividend and moderate growth. And so that's what we're doing. We've communicated a plan. Our plan, again, starts with increasing the profitability of our existing business. Secondly, we think down cycles and the cycle that we're in is going to create opportunities that we haven't seen in a while. There's going to be less competition because I think there's going to be fewer companies when this thing works its way through. Thirdly, is really what I just pointed to, which is taking care of our balance sheet, making sure that we have the flexibility to operate in whatever the environment provides. Lastly, I think we're on the very beginning of something that we're seeing across the midstream space, and I think we're a leader in this, and that is to drive organizational efficiencies by finding ways to do things we've always done with more technology and more efficiency, which will drive costs out of the business and allow us to see more profitability. An example of that, we used this example yesterday in our conference discussion, but we've created what we call a center of excellence here in our Dallas headquarters. We have put some of our best and brightest in the center of excellence, and what we're doing is taking a look at everything we do across the business, from the way we operate our plants, to the way we account to our producers. And we're running Six Sigma process and lean process approaches across those core operations, and finding ways to use technology, use data, and drive down the cost and efficiency associated with those activities. So we're excited about the early returns. We're seeing real profit. We're seeing better margins as a result of it. We're seeing better run times and real profitability being derived from the efforts that we have in that area.
Yeah. So you mentioned the balance sheet a couple of times. Could you just talk about what metrics you are currently targeting?
Yeah, so it starts with maintaining the strength from a debt to EBITDA or debt to earnings, and so we do target a sub 4 times debt to EBITDA ratio, and today we're operating at about 4 times debt to EBITDA, and so we want to drive that down. We want to drive down the leverage in the business so that it creates more flexibility for us. Secondly, we want to drive our payout percentage down as well, or our distribution coverage higher. Today, we are just distributing at a coverage of about $1.30 for every dollar that we pay out. So that's a 1.3 times coverage, and we would like for that to go up, and we are targeting that to go up to 1.5 or even greater if appropriate in the future. That's the first two metrics that we look at. Obviously, we're always focused on returns. We think today returns are going up as a result of just the need to higher cost of capital. Our dollars are costing us more today, and so we need to see more return for our investment. For EnLink, that means investing more right around our existing assets, looking at ways to expand the existing assets in what we would call brownfield type of growth, as opposed to new going into a white space and starting with a new asset. So higher returns, lower leverage, higher coverage. I mean, all of that is giving us more operating flexibility, and we think that's what you want to do in a cycle where we are today.
And what types of returns have you sort of thought about as being appropriate for EnLink?
Yeah, so I think the way we think of our returns is real return above our cost of capital, and also a risk-adjusted return. So there's not a magic number, but generally I would say we are looking for high teens returns, and in some cases even north of that, into the 20 to low 20% returns on our projects.
Yeah. So you mentioned your cost of capital, and one thing that really stands out to me personally is just your coverage ratio, or your distribution coverage is high, but your yield is also really high, which I'm curious how you addressed investor questions around the stability of the distribution, or how do you allay investor fears when they look at your yield and know nothing about you?
Well, I'd say that what the market is saying is that our distribution is not sustainable, and we've heard that loud and clear. What we have communicated, and we did many times yesterday at the conference, is that we believe that it is a sustainable distribution based on the projections that we have for the business. And here's the way I would say it. We can sustain distribution. I think the appropriate question, and what the question the market is asking, is should we reduce the distribution to create more flexibility in our operation and our balance sheet? And I think it's a valid question, and certainly something that we will continue to evaluate. But to date, as we've made the decision to hold our distribution where it is, and today we pay out about $1.13 on a roughly $5 stock price, and so as you said, just over 20%, and we will continue to evaluate that.
Yeah. Could you, now that you're back in the CEO seat, well, has your vision for the company changed, apart from making it more efficient and targeting higher returns? Are there priorities that you have now that, apart from those, that are different from when you were previously CEO?
Yeah, I think we are in a very different environment than we were, 24 months ago. And that environment was in a fast infrastructure build period to serve the growing basins of, at that time, we had, obviously, the Oklahoma STACK position was growing rapidly. The Permian's growing rapidly. The Eagle Ford's growing. The Haynesville is growing. Everything is in a growth mode. And so we, as a midstream company, were running as fast as we could to keep up. And we did a terrific job of that. The service level that we've provided through that high growth period has been fantastic. But as I step back into the CEO position today, we see a different environment. We see one with lower activity. And so we're now mining for opportunities to increase the efficiencies. We're driving out costs. One of the things we communicated recently was on a same-store basis, you take our assets and the way they operated in 2019, we believe there is $75 million that can be added to the profitability of that business in 2020. That is a combination of cost reductions, and that's across the entire system from overhead to our field operations. And then secondly, higher utilization, so more margin, more revenue. And lastly, just again, driving efficiencies to the point where we reach our full utilization and then expanding the capacity of those facilities in a very efficient way. And so that's what's different today. I think that cycle has at least another year in it, and that will be our focus. What we also have to do is be prepared for what happens beyond that, and that is to take advantage of some opportunities that you see in the down cycle to really grow your business. We've been a leader in that. There hasn't been a cycle that we've been through yet in the last 20 years that we didn't come out the other side better than we went in. And so that's our focus and kind of what I see as I step back into the position here.
Yeah, thanks for that. I'd like to get your thoughts on whether or not you think there are misconceptions the market has about either your company's investment story or the industry as a whole.
Yeah, so there are four things that we think the industry is really focused on as it relates to our story and our future. Number one, the market is demanding to know more about what's going to happen in our Oklahoma gathering and processing business. Again, we're moving about 1.2 billion cubic feet a day, which is a very large complex, generating over $400 million of segment profit from that business, or about 35% of our overall segment profit. The market simply wants to know if that basin is going to continue to grow. Are we going to be flat, or are we going to see a decline with the lower activity levels? That is something that we are not in a position to be able to say today, because we're waiting for producers to define their plans for 2020. So that's number one. I think in an environment where there is something that's unknown, people fill the blank with kind of a worst case, and that's what we've seen people do. We've seen people project that there will be little or no activity in Oklahoma, which would result in our case in a mid-teens type volume decline and a high single digits margin decline in that business. And so I think people are searching for, just what is Oklahoma going to do? Secondly, what the market wants to understand is in the broader overall company forecast, what would that mean? Are we going to continue to be able to grow our EBITDA from the 1.07 range that we've indicated for this year, $1.07 billion? And so that's the second thing. The third thing that the market really wants to understand is what we're going to do with our distribution. And are we going to reset the distribution given that, the market doesn't seem to be valuing it the way it is today? And then lastly, I think the market really wants to understand our large shareholder, Global Infrastructure Partner, owns about 45% of our company. And they really want to understand how supportive they're going to be in this cycle. And is that something that's going to be beneficial to our common shareholder? And so our focus is over the next month or so to deliver a definitive answer on all four of those things. The last one will be difficult. I mean, here's what we can tell you. They're our largest common shareholder. They have aligned interests with all of our shareholders, and me in particular. I think of them as being a great partner. I am a significant investor in this company, hold clearly a large position relative to anything else that I own. And so I feel good about GIP as a partner, and they're doing everything they can to help us in this difficult cycle, and will be just as helpful when we get to a better part of the industry cycle. So those are the four things I think the market is having to try to work through. It is our job to help them work through it in as short a time as possible, and we hope to be able to fill those blanks on some of the unknowns in the coming days.
Yeah, because we have talked a little bit about headwinds. I'd love to hear, what comes to mind, what comes to your mind when you think about tailwinds for the company.
Yeah, it always starts with commodity price in our industry, and so should we see an improvement in commodity price, and it doesn't take much. Today, we're natural gas prices are in the just above 250, and crude oil is in the mid 50s. And if we see any improvement, it can have a real difference in the cash flow to our producers and the activity levels. And so I think it always starts with commodity price. Secondly, I think that anything that would shift the general market sentiment towards wanting to invest, wanting more exposure in energy, could be a real tailwind from a stock performance standpoint. And I think it's possible. I think we've got to see some other things not perform as well as they have in recent days to cause people to really want to look for different ways to create value in their portfolio. And so there are a couple of things that could become tailwinds. And who knows? I mean, we seem to be in a very dynamic macro environment. And so, we could see some things improve from a global economic situation that could be helpful as well.
And I know you spend a lot of time talking to investors, even this week out at that conference. But from your perspective, what's the most important question about your company that never gets asked by investors?
Well, believe me, after as many meetings and as many questions as I had yesterday, it doesn't feel like there's any question that's been left unasked. But here's one thing I'm proud of, Nate. I think that we never spend any time talking about our lack of performance relative to the operations in our business. We have the absolute best operating team across our assets. The service that we provide to our customers is second to none. And so I never go into a commercial negotiation with a producer or a downstream market and have to explain lack of excellent performance, because we have performance excellence across all of our business. So they're a little bit like the referee that never gets noticed.
Yeah,
they're doing a great job. And so I think it would be that. We don't spend time talking about misses in terms of operation, cost overruns, or construction timing. Our team does an excellent job in executing across the business.
Could you tell or share with listeners just what you think was the most critical thing that's happened in your professional career that has impacted you as a CEO or helped you get to the CEO role or become a better CEO?
Yeah, clearly it's about the people. Picking the right people to partner with, having the right team in place. I've been very fortunate throughout the last 25 plus years to be working with great people. And I think that's it. I think it trumps everything else. Love the phrase that, you got to figure out, make sure you got the right people on the bus before you can determine where you're going. And we've always done that extremely well. And I think that served us and all of our stakeholders well today.
Yeah. And then final question, if you had to recommend only one book about oil and gas or midstream, what would it be?
Well, that's an easy one today. I think there are many, many books I love to read, but there's no book that we need more people to read right now than The Moral Case for Fossil Fuels by Epstein. We need people to understand the truth about our industry and the forecast for the use of fossil fuels. It presents facts and really gives both sides of the story. But net, what it wants the world to understand is that fossil fuels aren't going away. Because of low-cost energy that is derived from fossil fuels, we have a better way of life, and there are many people throughout the world who can still benefit from that. And so that would be it. In fact, I intend to send that out to a few folks this year around the holidays, as I think it makes a great gift and maybe gives people a different perspective than what they're hearing in the marketplace, which is that everything's going to turn into renewable energy. There's a lot left in the runway for fossil fuels. And so I'm glad to be a part of it and excited for EnLink and the role that we play.
Yeah. Well, hey, Barry, I really do appreciate your time coming onto the program, and it's been a pleasure talking to you. So thanks a ton.
You bet, Nate. Thank you. Appreciate you.
Yeah.
Bye-bye.
Good luck out there. Bye. Well, that's it, folks. I hope you enjoyed the interview. Sincerest thanks to Barry for coming onto the show. A really big thanks to Kate Walsh and Sarah Snyder, EnLink's IR team. This interview wouldn't have been possible without either of them. And last but certainly not least, a really big thanks to Dan Heim. Mike at Dan Heim gave me permission to use his music, so if you like what you hear, you should check it out. That's Dan Heim, DanHeim. If you get any value out of this Talk podcast, please consider making a donation, click subscribe, submit a review, or just spread the word. I'll leave it there. Again, hope you enjoyed the interview. Take care and good luck with your portfolio.